The Scoop Mortgage News with Matt Tews.
Welcome to The Scoop by the Tews team. I'm Matthew Tews, fearless leader of this team. The Scoop is a home loan answer center for you. It will be a location for business giddy up. It'll get you going. And what we're going to do in this first episode is introduce the idea of rent versus own and show what it looks like within one of our analysis. So let's get going. Enjoy.
What would it look like on a rent versus own scenario, as well as what if we got seller credits? So, starting, we've got three different scenarios to look at. We've got a $2,800 a month rental, which is pretty typical in the Diablo area. And I'd like to compare that to purchasing a $600,000 home around here. And that's about a 3-bedroom, 2-bath house. So, straight off the bat, you can see the first scenario that we have for purchasing, we've got a 10% down purchase. 30-year fixed at about 4.25 with decent credit. So $69,000 is needed for cash to close on a 10% down purchase. Now, if we're going to compare this purchase price and the monthly costs to our rental, which I've added $20 in, by the way, for renter's insurance, we could check a little more info out and see what the payments look like. So on a $600,000 purchase, principal and interest payments are $2,656. You've got property taxes, hazard insurance, and a mortgage insurance payment. That is monthly. And that's because we only have 10% down with a single loan instead of having 20% down, which is required to not have mortgage insurance. So the total payment for housing is $3,653. So that says it's a lot more than $2,800 to start off with. However, let's look at what the tax benefit of being an owner is. Tax benefits per month would be $659. That on top of we're actually paying principal, so we're putting money into a pot towards ownership, and that equals about $743 a month going into principal. So at the end of the day, what it costs to own a house is about $2,250 per month. Okay, now that's just straight 10% purchase. What if we offered more money for the house by $10,000 and we requested that the sellers give us a lender credit or a seller credit? So this $10,000 seller credit goes directly towards cash to close as far as paying for well, in this instance, what we're going to pay for is an upfront mortgage insurance payment. So no longer will we have the hefty $297 per month because we're going to pay an upfront mortgage insurance premium, and we're going to use the leftover money from the $10,000 to achieve a lower interest rate by buying down the rate. So what does this get us? That gets us a $300 savings per month in the monthly complete mortgage payment, and you also still have the tax benefits. So at the end of the day, we're spending $1,941 to own this house per month as opposed to $2,800 going to somebody else to own their house. So this is one way that we like to look at things. I try to go through different scenarios with families. We like to see what would benefit them most. Where do we need to keep the most savings? Is it a monthly issue? Is it most wise to go into a 15-year fixed rate? Is an ARM the best idea? So this is the type of tool that we use to go back and forth and look through scenarios. And in this instance, comparing renting to owning with some seller credits. So this is Matt Tews with the Tews team signing off. Thank you for joining us. Have a great day.